Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. The S&P 500 and the Nasdaq on the brink of closing at new highs here. It is green across your screen, and financials and tech stocks leading the way here on Wall Street. The White House also saying that July 9th tariff deadline is not critical. Plus, bets are rising that the Federal Reserve will be cutting rates at its next meeting as the White House pushes back on a report it's gearing up to announce Jerome Powell's successor. And we're taking a deeper dive on shares of Nvidia as well, which is rallying to a new high. Let's bring in our ensemble of experts to break down the action. We got Yahoo Finance's Julie Hyman down at the New York Stock Exchange, as well as Christine Short, head of corporate event research at Wall Street Horizon, a TMX company, and Yahoo Finance's very own Josh Schaefer, who will be joining us throughout the show to break down the headlines. Schaefer, let's start with you as stocks are rallying here ahead of the close. Are we at the record?
We are not quite there right now, Josh. We're going to need a little bit of a rally in the final hour of trading here. So I underlined our number for the S&P 500. Right now, we are at 6,139. The prior close, if we go back, or the prior record close, if we go back to February, I'll throw a 6-month on here so you can see it, was 6,144. That was on February 19th. So that is sort of your number to beat to get a new record high, closing record high for the S&P 500 for the first time since February, about 4 months. But I want to get into, Josh, what's sort of been driving the market, I think, today and really over the last couple days, which is you've seen rates come lower as there's been an increase in expectations for the Federal Reserve to be cutting rates sometime soon. So I'm looking at the 10-year here. That's down about 12 basis points over the last 10 days. And when I flip over to this has been an interesting one to watch this week. What we're looking at here is bets that the Federal Reserve will cut rates at its July meeting. That is the end of July is when that meeting is. What you're looking at in green here is what the bets are today. So market pricing in about a 27% chance that the Fed will cut at that July meeting. This comes after some soft labor market data this morning, continuing to see signs of slowing there. Notably, just a week ago, only a 12% chance. So you've seen investors become a little bit more optimistic about the rate cut, and I think that's part of what's been driving the market a little bit higher here.
And Julie, speaking of records, Nvidia on track for another one here today. What's been driving those gains, and what's the just general vibes around the rest of the chip sector?
Yeah, I mean, we've seen some broadening of the chip sector that we've been talking about recently. Nvidia itself is up about 16% year to date. And basically, we've seen it make the same round trip that the rest of the market has made, right? There have been export controls that have affected the company's revenue in China. But on the flip side, it just keeps delivering in terms of the demand that we are seeing for its GPUs to go into AI data centers, and also in terms of that sort of forward-looking demand and its ability to supply enough to keep up with that demand. So Nvidia itself has been doing well, but I also wanted to take the chance to look at overall what we've been seeing move in the S&P 500. If you remember yesterday, we looked at what had done best since the market lows in April. Today, I just wanted to look at simply year to date, what's gained the most. The best performer in the S&P this year, it's Palantir. And that stock, by the way, is also trading at a record. We don't talk about it as much in terms of the records because it's been kind of day after day after day that Palantir has been hitting records, whereas Nvidia hadn't been hitting them for a little while. NRG Energy, remember we talked to the CEO of that company recently about its climb towards a record, especially after it made an acquisition of some gas-fired power plants. And then you see kind of a mixed bag here. Seagate Technology, which is a disk drive company, storage company, Howmet Aerospace, Supermicro Computer. So, and Newmont Corporation, by the way, is also on that list of one of the best performers, which is kind of fascinating. Gold, as we know, has been doing pretty well. On a sector basis, it's industrials that have actually done the best year to date here. They're up 10% as a group, so not tech. That's not been the best percentage performer. Communication services, though, which is techie, right, includes stocks like Meta, is up about 8%, and then financials and utilities. So this broadening, remember like when everybody was saying, we need the market to broaden, we need the market to broaden, it's happened. The market the rally has indeed broadened beyond just the Mag 7, and the Mag 7 aren't even all outperforming this year, Josh.
Christine, let's bring you in here as well. You know, Christine, I'm just looking at the screen here, the popular averages, green all over the place, Christine. We just keep grinding higher here. What do you make of it?
Yeah, look, investor appetite is there, right? AI enthusiasm has returned. We just talked about Nvidia. I think there were some whispers today about, is this, signifying a bubble here? Is this .com 2.0 with Nvidia being at almost record highs here? And if you look at what analysts are saying, and I know we're going to hear from one, that covers Nvidia here soon, no one's saying that this is overvalued. I think many are actually saying that we're still undervalued here on Nvidia because we haven't quite priced in AI and the impact on productivity. We heard from CEO of Salesforce today, Mark Benioff, saying that 30 to 50% of their workload is now done by AI. And we've seen a slew of companies cut, positions because of AI, whether it be Salesforce or CrowdStrike, Klarna, or Duolingo, who's actually going to be more discreet about hiring because of AI. So I don't think we've folded in the full impact. The one concern I have, and maybe it's not so much a concern, but what I'm watching is competition from Chinese AI companies. There was a great report in DataTrek Research earlier in the week that just showed the valuations are so much more appetizing on some of those Chinese AI names versus the US ones, and the returns have actually been higher for those names. So that's one area that I'm watching is the competition between us and those Chinese AI names.
Josh, Julie mentioned it briefly, but I just want to get double tap on it. The Mag 7 names, Josh, those giants, right? How have they been working?
Yeah, Josh. So I have a visual representation over here on our big board, right, of sort of some of what Julie was talking about. And what I'm looking at here is just performance since the April 8th low. Most of these stocks here are all in the top 20 of the S&P 500. They're all AI tied. So I looked at sort of an AI basket of stocks, right? You have Oracle, Broadcom, Dell, AMD, NRG, as Julie mentioned, Vistra, which is sort of an AI power play, and Palantir. What's interesting is all of the Mag 7 have underperformed them, right? So Nvidia's up about 60% at a new high. Really, the rest of these companies have come up about 25, 30% maybe from the bottom. Apple hasn't really gone anywhere. And Christina, I guess the question this sort of brings me to for you is just, is the next AI trade gonna continue to be the broadening out of this trade into cloud computing, into energy, into some of the other chip names? Or is that sort of where it feels like this trade is headed as we go through kind of the second half of 25?
Yeah, I think we are already seeing that broadening out. There's a lot of liquidity in the market, and I think what surprised me the most is how quickly we've rebounded from that April low, and it just goes to show the appetite, the enthusiasm amongst all of tech. So not just within the AI space, but there is liquidity there. There was cash on the sidelines for quite a while, and now many of those investors bought the dip, and now we're seeing it rip.
All right, well, sticking with that AI trade, let's talk about Nvidia here, because those shares at a new high, raising fresh questions about the company's valuation, of course, well, including from our next guest, who's neutral on this stock. Join me now, we got Gil Luria, D.A. Davidson, Head of Technology Research. Gil, always great to see you. Let's talk Nvidia, because what a move, Gil, off that April low. I'm curious how you explain that move, Gil, and what you see from here.
Yeah, so we're very excited about AI, and the excitement in AI is helping a lot of the stocks as you've just been discussing. So first and foremost, companies like Palantir up 90% this year, Nebius, NBIS up 90% this year, but then Avago up significantly, Microsoft up 18% this year. Nvidia is participating, it's up 16% this year, maybe more from the bottom, but in terms of year-to-date performance, it's participating as it should be. It's very hard for us to get to our goals on AI without building that around GPU-based data centers. And so NVIDIA is participating. As we sit here today, it's trading at the high end of its multiple range. It's trading at 36 times earnings. That's traditionally closer to the high end of its range. As its growth decelerates, you brought up an important point, which is they're clicking on most cylinders, but China continues to be a risk. The consensus estimates for the next few quarters incorporate continued business from China in spite of the fact that it's currently frozen. That's possible that China business come back, but it's not a foregone conclusion. So we are very excited about AI. NVIDIA is one way to play it. We have better ones. Again, Microsoft, Nebius, smaller companies like Blaze. There's plenty of other ways to play Datadog, Snowflake, that are not NVIDIA, but NVIDIA will participate.
Gil, I could be oversimplifying. I often do. That's why you're here, Gil, to check me. But I bet some folks, Gil, think, isn't it just as easy to think, you know what, if big tech, Gil, is going to keep spending like this, billions and billions and billions of dollars, building out their AI infrastructure, not to mention the sovereigns, right, Saudi Arabia, UAE, then just stick with Jensen Huang's company. Why is that wrong, Gil?
Because Microsoft Azure is going to grow faster than Nvidia, and that's recurring revenue. So even if Microsoft, Amazon, Google, et cetera, continue to buy from Nvidia, these are one-time purchases. The more data centers they build out, the less they're going to need to buy. They're already slowing down the rate of that growth. And other participants may be making up some of the difference, but Nvidia's growth will start slowing down, while Microsoft Azure is growing 35%. Microsoft is growing double digits, expanding margins. So the growth rates are converging. Microsoft is at 33 times earnings. Nvidia is at 36 times earnings. Microsoft's revenue is recurring. Nvidia's revenue is hardware, it's one time. So we still prefer Microsoft to Nvidia. But again, that's not to say Nvidia will not continue to grow from here, which is impressive, because we're talking about them doing $200 billion of revenue this year. They're going to grow that number into next year, just not nearly as much as they're going to grow into this year.
You know, Gil, I know some colleagues of yours on the street, big fans of AMD, and they say, you know what, Lisa Su and her team, they're gonna narrow that gap with Jensen Huang and his crew over at Nvidia. I am curious broadly, Gil, how do you see the competitive landscape evolving for Nvidia?
Yeah, so that's the other part of it, is that Nvidia has almost the entire market right now. The number two, the distant number two, is actually Google TPUs. Broadcom, which Broadcom supplies, so in that sense, they're also in the mix. But AMD, Intel, all those are really minor players. Going forward, we expect the custom chips made by Broadcom, Marvell, and others to have a bigger share of the market, AMD to start growing from that very small base, but very importantly, tying to the conversation you started earlier, Huawei. The more restricted Nvidia is selling into China, the better glide path there is for Huawei to accelerate growth and take bigger and bigger pieces of the market. So again, Nvidia participating, just will the shrinking share, because they're starting with owning almost the entire market. There's only one way to go from there.
All right, so Nvidia obviously in focus, but there were other names we know on everybody's radar. So I wanted to bring in our ensemble here. Got Julie, got some reports on CoreWeave, Julie, which is also a name Gil knows very well. She's a Core Scientific. They're surging after the Wall Street Journal made some headlines. Bring us up to speed on that.
Yeah, so the Wall Street Journal is saying that CoreWeave is in talks to acquire Core Scientific. And this is something that CoreWeave had tried to do last year, and Core Scientific had spurned its offer as too low, and indeed Core Scientific has only gone up from there. It's valued at much more richly now, a market value over $3.5 billion. Its market value at the time, and the offer that CoreWeave was making reportedly around $1 billion. So it's more richly valued now. So we'll see what ends up happening with this. I mean, CoreWeave, as we know, also has a richer currency. It went public back on March 27th at $40, and the stock has gone up nearly threefold since this time. By the way, just to give a little context here, CoreWeave, which provides data center space, if you will, to a lot of the demand for it, versus Core Scientific, which owns infrastructure for Bitcoin mining. And a lot of that Bitcoin infrastructure has now been transferred over to be AI training infrastructure in some cases, Josh.
So Gil, I want to bring in you here because you being here, Gil, perfectly timed as always. You covered this name, Gil. You have the equivalent of a sell on it, I believe, my friend. So not a fan, but what you saw that report, Gil. What did you make of it?
CoreWeave is losing a lot of money, and buying another company that's losing a lot of money isn't going to necessarily solve the problem. CoreWeave mostly leases data center spaces, as Julie was pointing out. And this is an example of them trying to buy some more data center space itself. It's a type of vertical integration. But again, Core Scientific also loses money. So that's not going to help. To the extent that CoreWeave can use a very, very expensive, overvalued stock to make the acquisition, that's great. But if they need to borrow money to buy Core Scientific, that's going to make a really bad balance sheet even worse. So we hope they're using stock. In that case, it's fine. They're doing vertical integration. But it doesn't change the fact that CoreWeave is really managed for the benefit of their debt holders. Equity holders own almost nothing.
Gil, always great to see you. Thank you for joining us.
Thank you.
So, Christine, you saw the headlines as well. I'm just curious to get your take on those CoreWeave reports.
So deal making has been slow lately. I think it's a great sign for deal making in general, and we know M&A has been really weak this year. And I actually expect more deals like this to come about. Crypto miners, as we know, use a ton of electricity. So you're seeing larger AI partners trying to, target them as they try to consolidate power supply, as they, they're hungry for energy. And so it's an interesting to hear Gil's perspective to companies losing money. We don't quite know the structure of the deal. Again, it was rejected just a year ago at $1 billion. They're now valued at about $4 billion. So, who's to say if it will go through or not? But I just think this type of deal making is something we're going to see more in the future.
Just a quick broader question for you. When you look at the moves, Christine, we're seeing in names like a CoreWeave or a blistering rally in a Circle, or I'm looking today like a QuantumScape. We'll talk to the CEO later in the show. It's up 30% today's trade. Are those moves trying to tell us as investors something broader about the market?
Yeah, look, we're returning to some of these riskier names. These are the growth names that were the safe haven a couple years ago, and then we kind of moved away because there was so much uncertainty in the market. And what's so surprising to me is that uncertainty has not gone away. We still have aggressive trade policy. We have conflict in the Middle East. Yes, the last couple of days with the ceasefire, the feelings are a little more bullish on that coming to a conclusion. We've got, again, competition from China. So there's still all these factors and headwinds out there. But it just goes to show the investors are super resilient and want to believe and have this enthusiasm. And so I'm just surprised with how quickly the rebound has come in with a vengeance, because it's not as though there are no headwinds out there. And there's still a lot of things that we need answers on that will go through the rest of the year. The next big target for some of these companies is earnings season, which starts next month. So we'll see how some of them report, what they have to say on those calls. But yeah, some of it is a little bit surprising, the confidence, the enthusiasm.
Yeah, Julie, Christine made a good point there. Plenty of questions still on a number of fronts, but as she points out, it is risk on with a lot of confidence.
Yeah, it's risk on, and I wanted to come back to this M&A idea a little bit too, because that also, as you pointed out, is a potential sign of confidence, even though we're getting these reports of deal talks between certain companies. One of the things that we've been noticing as of late is the outperformance of the financials, right? JP Morgan, for example, is trading at another record. And you have to wonder if some of what has been driving that enthusiasm is sort of paired with the enthusiasm for maybe IPOs coming back in the market or deals coming back in the market, which are a source of revenue for some of those big banks like a JP Morgan for their investment banking operations. And Christine, I wonder if that is something that maybe is driving some of that, if the two are sort of tied together.
Yeah, we've been talking about that heading into earnings calls for the last couple of quarters, because it was supposed to be the year that IPOs were back. It was supposed to be the year that M&A was back. Q1 was still a little light, but we're not as bad as we were in the last couple of years. So you're starting to see improvements. We just did a report the other day. I think there were just over 60 IPO announcements in Q2. We've still got a couple days of Q2 left. That's not the worst we've seen. Q4, I think we saw just about 50 announcements. So we're slowly making these improvements. It's nowhere near what it was in 2021 and 2022, and that's what everyone remembers and thinks we're going to get back there. But I think the average IPO announcement per quarter is something around the 70 to 80. So we are slowly moving our way back there. And you're right, that is a lot of the momentum within the financials names is, hopefully we get this Fed rate cut that will shore up some more deal making and some, and look at the IPOs. Many of them have done very well this year, and that wasn't so true last year. So I think there's got a lot of good things going for them on the investment banking front.
Yeah, we spoke recently to Greg Martin over at Rainmaker, who said, he expected plenty of new listings, but Greg wasn't so sure how long that IPO window would actually stay open, given all the question marks, some of which Christine was bringing up there. All right, we are just getting started here on Market Domination. Coming up, President Trump getting closer to naming his replacement for Federal Reserve Chair Jerome Powell as his patience with the central bank chairman runs out. Stick around. We can dive into who that replacement may be when Market Domination returns. President Trump could be getting closer to naming the successor who will replace Jerome Powell as Federal Reserve Chair. Yahoo Finance's Jennifer Schonberger joins us now with the latest. Jen.
Good afternoon, Josh. President Trump's desire to replace Fed Chair Jay Powell is reaching fever pitch. Furious over the Fed's wait-and-see slow-walk approach to cutting interest rates, President Trump is considering announcing a new Fed chair pick early to undermine current Fed Chair Jay Powell, whose term does not end until next May. Trump told reporters on Wednesday he's narrowed it down to 3 or 4 candidates, and 2 people close to the administration tell me the president could make an announcement soon. Here's a look at a short list of those potential candidates. Topping that list is Kevin Warsh, a former Fed governor from 2006 until 2011. He said in a Wall Street Journal op-ed earlier this year that he believes any inflation from tariffs would be of a smaller magnitude and that he would look through them as a one-off price change. He thinks inflationary effects from larger tariffs are also overstated. Next up is Chris Waller, a current Fed governor who has said that he could see cutting rates as soon as the next policy meeting in July. Waller says he believes any inflation from tariffs will not be longer lasting and supports looking through any tariffs to set rates, a view that is in line with the White House. Then we have Treasury Secretary Scott Bessent. He told House lawmakers earlier this month that he'd like to stay in his seat until his term ends to carry out the administration's agenda, but he hasn't dismissed the possibility of being the next Fed chair. Bessent has largely stayed out of voicing his opinion on monetary policy, as any Treasury Secretary would, only saying that the administration is looking to bring down bond yields, which influence interest rates, through pro-growth policies like tax cuts, deregulation, and trade negotiations. He's refuted the notion that tariffs could lead to any persistent inflation. We also have Kevin Hassett. He's a trained economist and currently director of the National Economic Council, which advises the president on economic policy. And he has said there is no reason that the Fed should not be cutting rates right now. And rounding out that list is David Malpass, a former president of the World Bank, who reportedly says the Fed needs to look towards setting the groundwork to cut rates to boost growth, noting that the Fed's forecast for growth this year is low. Now, Josh, I am getting actually conflicting information from multiple sources on potential candidates on this short list. A longtime economic aide to the president, Steve Moore, told me earlier today that Waller may not actually be in the running because he was not in favor of cutting rates at the Fed's last policy meeting. At the same time, another person close to the administration says that Kevin Warsh, who had been at the very top of the list in the running for the president for months now, is one that the president has soured on. A senior White House official telling me that no decision is imminent and the president has the right to change his mind.
All right,
a little bit of flexibility there.
The drama continues. Thank you, Jen.
Yes.
Appreciate it. The GOP is using a controversial budget maneuver that is hiding $3.8 trillion in President Trump's tax bill. For more, we're bringing in Yahoo Finance Washington correspondent Ben Werschel. Ben.
Hey, Josh. Yeah, so while negotiations grind on Trump's big, beautiful bill, what I wrote about today was this concept called the current policy baseline. I know this is kind of a wonky inside baseball concept here in Washington, but this is massively shaping how the bill is being discussed this week. Economists hate it. To set the baseline. They call it an egregious budget gimmick. And it's why you see the same bill coming out and being scored 2 different ways. In one example this week, the tax portions of the Senate bill, you could either say it costs $442 billion or $4.2 trillion. And this is because the Senate argument is that any tax rate currently in policy and that's being extended should count as 0 because it's not changing. And that, of course, is about the individual tax rates in the 2017 Tax Cuts and Jobs Act, which expire at the end of this year, and is the sort of main point of the tax bill to extend it this year, making that cost zero. And this all comes as we're kind of entering this final stage of negotiations on the bill with the final shape of it far resolved and a lot of changes we've seen just in the last few hours. suggesting that the price tag here could go higher and make things even harder for the fiscal hawks who have to vote yes for this to pass. We've had John Thune has acknowledged that a vote starting tomorrow may not be possible, but the Senate is still trying to get this going for the weekend. One comment I heard just a few minutes ago was that the goal here is for final votes by the time work begins on Monday. So we'll see how that goes.
And Ben, what is the latest, by the way, on Trump's tariff revenue? He likes that revenue, Ben. So what's been coming in?
Yeah, so we get an updates on this nearly every day from the Treasury Department. They have a daily statement, and that gives you customs and certain excise taxes from the Department of Homeland Security. And they come that in, and there's usually a big deposit about this time of the month. And we had the one from for June. And what it shows is that we are on pace for another record month of tariff revenue. It's 26.7 billion has come in so far under this metric, and 121 billion has flowed in through the entire fiscal year so far. And that's another jump from last month, and kind of comes as Trump's tariffs continue in place, and they promise that they're going to keep going on. And this comes also after the Congressional Budget Office has talked about how tariffs could add somewhere in the neighborhood of 2.8 trillion over the entirety of the next decade if they stay in place, and if Trump, even after Trump is scheduled to leave. The reality check here is this is still a long ways off, even with this really significant jump, from being a huge piece of government revenues. The government takes in north of $300 billion every month, sometimes much higher than that during tax season. So this is still about 5% of government revenue, which is a big jump from 2% that it was in recent years, but it's still a long ways from the big ones like income taxes.
All right, Ben. Thank you. Appreciate it. Well, on top of all the news from Washington that's driving market action, it was also a busy day on the economic calendar, from the labor market to durable goods to GDP. Joining me now is Luke Tilley, chief economist at Wilmington Trust and former Philadelphia Fed economic advisor. Luke, it is good to see you. So we did get that rush of economic data this morning, Luke, but I'm more interested, you take out your crystal ball, Luke. What do you see ahead for this U.S. economy?
Yeah, I think the data this morning is really confirming a lot of what we have been expecting. The headline of GDP revised downward was principally because of slower consumer spending, and that's what we had been expecting for quite some time. Consumers really ramped up their spending, especially on autos, but on some other items as well in the fourth quarter. And then we see a lot of give back in the first quarter. And all of those tax revenues and tariffs that you were just hearing about are being paid by consumers and businesses. And frankly, we don't expect that consumers are able to afford those tariffs and also keep spending on other items. So we've seen tariffs show up in the CPI on a lot of the goods that are imported, but we've seen weakness in things like recreation services. And we saw weakness in today's GDP report on spending at restaurants and bars. And so we really think the tariffs are taking a chunk out of growth just because they're forcing consumers to spend less elsewhere. So we have a 50% probability of recession over the next 12 months. And it's really going to tip the scales on how it's going to be tipped one way or the other, depending on how businesses react and how much they keep hiring, Josh.
So, Luke, so a 50% chance there of a contraction. How deep and long would you expect that recession to be?
We're not expecting it to be very long. So it would be mild and it would be a couple of quarters, but we would see growth coming down below zero in a year-over-year sense by the end of this year. That's at the bottom of the range of forecasts. But that is because we would see consumers pulling back. We already know that consumers are pretty challenged with what we see with going on with credit delinquencies. We see businesses as pulling back on CapEx and on hiring, and that leads to a flattening out and then a little bit of a decline in the back half of this year. So it is a mild decline that we have penciled in. One of the risks that we see is once you start to see a little bit of a turn and a topping there, forecasts tend to migrate downwards if things get worse. So we're watching very closely what happens with consumer spending and what happens with hiring and CapEx. That
tariff inflation that could be coming, Luke, I'm just curious, do you see that as, is it transitory, which is, it seems to be what Waller is suggesting he sees, or no, you would think it's more persistent?
We don't even really see that much inflation coming from the tariffs, because for every increase in the price of an imported good, it's being taken out of somebody going on vacation or a hair flight, an airline flight, or to the hair salon. So we really don't even see that much inflation. And yeah, to the extent that we do see increases in the prices of imported goods, definitely transitory, because you have basically it's a one-time increase. And then once you get out past 12 months, it falls right out of the year-over-year calculation. And we expect that the hit to growth is going to be much larger than the hit to inflation. And really, the thing to be concerned about here is the impact on the economy and growth. And we think that's going to be downwards. And that's why we have that 50-50%, that 50-50 chance of recession, Josh.
What about Luke Trump's big, beautiful bill? Those tax cuts get extended. How stimulative could that be for the economy?
We see some stimulative effects there, but as you were just discussing, a lot of those are already baked in because we're extending tax cuts that people have now. Nobody's paycheck really changes with this, except for people who are earning overtime, and then you've got higher child tax credits. To any extent that there is a boost, we think it would come more on the business side, where we've seen that business expensing start to move down in terms of the percent you can do. It moves back up to 100% in the bill of expensing of equipment, and that does entice some businesses to spend more. But again, that's just going to tilt them more towards the CapEx side of thing and on the margin away from hiring. So we would be worried about consumers going forward. That's why there's so much focus there for us.
Luke, we did mention your Philly Fed economic advisor. I was just curious, when you saw this headline from the Journal, Trump considering naming the next Fed chair early in a bid, they say, to undermine Powell. I'm just curious, as an economist and with your background, what kind of impact do you think, if anything, if at all, Luke, that has on the FOMC?
I really don't think it has any impact on the FOMC at all. One of the best checks on the people who go on to the FOMC is the Senate Finance Committee that has to approve of these nominations. And they really are a good check and have been over time. At sometimes probably even more stringent than they needed to be. So I don't think that there would be a very large impact. You've got 19 people not on the FOMC. There's 12 people on the FOMC at any time, 19 participants, and they really are a check on anybody who is brought into that institution after they get past the Senate Finance Committee. I wouldn't want to be the person who's nominated and having my word scrutinized over the next 11 months, because when you sit in front of that Finance Committee 11 months from now, you're going to be fact-checked on everything you said over the next 10, 11 months. And also, as Jennifer was saying, the president will be watching closely and retains the ability to change his mind. So probably the most scrutinized person in financial markets if it does happen.
Tough job. Luke, thank you so much, as always, for your time. Appreciate it.
Thank you.
Coming up, solar stocks burning up today. We're going to check in on some of our top trending tickers on the other side. Stick around. Much more market domination still to come. Now time for some of today's trending tickers. We're keeping our eye on solar stocks. Equinix and the trade desk starting off with those solar stocks, seeing gains today following the news that Congress is reconsidering putting clean energy tax credits back into that big, beautiful bill. Enphase, one of those stocks, seeing a 10% price hike after dropping 38% year to date. These tax credits continuing would be a necessity for the solar industry, which we know has seen weakening residential demand. Julie, I know you know this sector well. What do you make of these moves?
Yeah, I mean, a lot of this is speculation. We don't know what's going to end up in the final version of the bill, but really it seems like the industry, which has been lobbying very hard to keep these credits in, or at least make the phase out more slow and more gentle to it, they've been lobbying really hard. And there were some comments from a senator from North Dakota earlier in the week that said maybe they could soften some of it a little bit. So the stock surged on Tuesday. They didn't move much yesterday, and they're surging again today as we get closer to a potential vote and we'll have to see the final version of the bill to see indeed what ends up being in there. But these credits are really important to these businesses, to these solar businesses. They have spurred demand, especially in an era of high interest rates, right, for consumers who are trying to finance solar panels on their homes. So the stakes are really high here, and you definitely see a lot of volatility in these names, which have really been beat up in some cases this year. Because in some cases, Josh, this is kind of existential about whether these credits are going to continue or not.
Christine, I want to bring you in here as well. So some of these names that popped today, Christine, but man, some of these names have also been whacked.
They've been beaten down, you're right, over the last month. I think the Invesco Solar ETF has been down about close to 10%, especially since the announcements on these tax credits not being continued came out. But yeah, today, I mean, I was looking at Ascent Technologies up almost 150% on this news. But as Julie cautioned, we don't have It hasn't happened yet, and we know these things tend to change. We don't know what credits would be staying, what would be going away. So I would exercise some caution as we sort of try to figure out what gets voted on. But for now, yeah, certainly a win for the solar stocks that have been, again, kind of a dog of a group for year to date.
Dog of the group. Well put, well said, and accurate. Finally, Equinix shares fallen today at the announcement of the company forecasting below estimated revenue growth. The data center firm also reporting heavy investments in order to cater to AI demands in the future, which the company plans to double its current capacity over 5 years. Raymond James, BMO Capital, also choosing to downgrade the name because of the projected cost to double the company's AI capacities. Raymond James saying here they took this one out of market perform, so a hold. They talk about amidst of a multi-year shift in its business. They say changes are likely beneficial in the long run, but there will be some pain out of the gate, Julie.
Yeah, and we've already seen some pain for Equinix, even if you don't take into account what we're seeing today. But including it, the shares are down about 20% so far this year. So it's really the kind of short-term pain for long-term gain that you just referred to here, the company making that investment in doubling that capacity in data centers, which is a data center real estate investment trust. And how investors feel about it depends on which analyst note that you're reading. So you mentioned the one from Raymond James, which is not so positive on it. But then I was also looking at some research from Michael Funk over at B of A. He's got a buy rating on this one and a $950 price target. And he says lower than previous, that adjusted funds from operations per share, which is the metric that you look at for REITs here. He says the lower than previous guidance on that and dividend growth guidance coupled with levering up for future growth is a negative short-term shock to sentiment, he said. But he's looking at strong projected AI inference growth and commentary on customer demand. He says that justifies the investment in this stock. So again, it's kind of a matter of opinion here, Josh, depending on how these various analysts and investors want to read it.
Yep. The stock is down about 20%. Still the street, though. 80% of analysts paid to give you an opinion. They like this one. Well, stocks higher ahead with under a half hour to go to the closing bell. For more on the latest market moves and how investors should be positioned, let's welcome in Charles Seismore now, Seismore Capital Management Chief Investment Officer. Good to see you as always. Let's start with the popular averages here. I got green all over the place, Charles. All major averages in the green right now. We're grinding higher. That makes sense to you, Charles, or no? Do you think we're being kind of complacent? Plenty of questions, of course, still out there, right? I mean, trade and tariffs. I just had a smart economist on the show, Charles, told me there's a 50% chance we're going to trip into a recession. So what do you make of these market moves?
Well, I think he's being conservative to say it's only a 50% chance of a recession. But yeah, this is a very complacent market. We went into this year with the market priced for absolute perfection. Of course, we didn't get perfection when we ended up with a trade war, a lot of volatility in the administration, and of course, the Middle East war. All of that had the effect of knocking stock prices down for a bit, but now we're right back where we were in February, touching new all-time highs here. That's a very aggressive market. You have the S&P priced at about 28 times earnings, which is a very expensive valuation under even the rosiest scenario. And measured by sales, it's trading at about 3 times sales, which puts it at one of the most expensive markets in history. So yeah, there's a lot of optimism built into this market. Is it too much? I guess we'll find out soon enough. But yeah, investors are they're pricing in really good things coming in the rest of the year.
And so, Charles, the valuation's maybe looking a bit stretched according to some metrics. You don't see us growing into that. What do you see for corporate profit growth with earnings season, Q2 earnings season coming up?
That's going to be really tough because the environment we're in right now, post-tariff, makes comps really, really difficult. So will earnings growth even be higher at all this year in a lot of sectors? I really don't know. Like that is really, that remains to be seen. But going forward, the 28 times earnings is of course at trailing earnings. The metric does get a little bit better if you're assuming pretty robust earnings growth. I'm not so sure that's a realistic expectation, though.
So, Charles, you sound cautious here. Against that backdrop, where do you want to be committing capital, Charles? How do you want to be positioned?
Yeah, in a market like this, it probably doesn't make sense to put a lot of buy and hold capital at play. So you can really go about this two ways. You can focus more on short-term trades, or you can focus more on income. And I think right now, with some of the yields we see in certain pockets of the market, taking an income approach makes a lot of sense. Business development companies are a fine example there. A lot of these are yielding in excess of 10%. Some of the more conservative ones are yielding 5 to 7. That's really competitive if you believe, as I do, that we're likely to be in a range-bound market for probably the rest of this year.
When you talk about these business development companies, these BDCs, Charles, which ones make your radar?
Given the economic uncertainty, I think you do want to focus on the conservative names right now. I don't think you want to stretch and go for the super high yielders. Main Street Capital is probably the highest quality blue chip in the group. They have a very conservative dividend policy, which I like. They pay what I would call a sustainable monthly dividend. And then as earnings allow, they top that up with special dividends. So if you look at just their kind of conservative monthly regular dividend, it's yielding about 5. You add in the special dividends they've had over the last year, that pushes that yield to about 7. Now that the special dividends vary, of course, but a 5 to 7% yield with a very good possibility of that dividend rising over the next year and then every year beyond that is attractive. This is a company that has managed to maintain or raise its dividend through every economic setback we've had since 2008. That's attractive.
Charles, appreciate your time and those picks. Thank you, sir. Crypto-related stocks enjoying their time in the sun amid a run of optimism in the industry. Yahoo Finance's Inez Ferre joins us now with a closer look. Inez.
Yeah, Josh, and I want to point out 2 stocks in particular that have just been on fire. First, let's start with Coinbase. Coinbase is on pace to close at a record. Right now, the stock is at $374 per share. And this stock has seen really a remarkable turnaround. Do you remember back in 2022 when it hit a low back then? The stock is now up more than 950% since that time. And Bernstein this week called Coinbase the crypto universal bank, a one-stop Amazon of crypto services, because the analyst was pointing out that beyond its trading platform, it has really gone into a multitude of other crypto-related services for institutions, custodianship, and also its leadership within the stablecoin space. Which brings me to the next stock that we're looking at, and that is Circle, which IPO'd back on June 5th. This is a pure play of stablecoins. By the way, Coinbase is a minority stakeholder in Circle. And this is the issuer of USDC, a US dollar coin, many of which these are backed by short-term treasuries. And the stablecoin bill last week really was significant for this stock. And it's bullish for the crypto industry as a whole. One analyst, though, did warn that when it comes to Circle, he put on a neutral rating this week, warning of more competition because of this regulation that's coming around stablecoins, because this is going to attract more competition. But look, other analysts are talking about widespread adoption of stablecoins, that that Circle will be capturing market share from Tether, which is a privately owned issuer. And as far as the volatility for this stock is concerned, because we've seen the stablecoin really one day go up 15%, the next day go down 15%. Look, I spoke to this one researcher that told me he's very bullish on this, and he says it's not so much its volatility, it's a reflection of a highly underpriced IPO. And he makes a point that Wall Street has been making now for some time when it comes to stablecoins. He's saying that Circle, Tether, these are companies that are big buyers of short-term treasuries. This is providing funding directly to the U.S. government for its debt. And so that there is an incentive from the federal government to cooperate, to work with stablecoin issuers. This is very bullish for this type of stock.
All right. Thank you, Inez.
Thank you.
Stick around. Much more market domination still to come. QuantumScape shares, they are soaring for a second straight day. The EV battery developer saying Wednesday it hit a breakthrough for its solid-state lithium battery technology. And joining me now is QuantumScape CEO and President Siva Sivaram. Siva, it is good to see you. I thought maybe start high level. For the uninitiated, the solid-state EV battery, Siva, walk us through what are the potential advantages of that technology? You know, is it cost? Is it safety? Is it range? Is it all three, Siva?
Yeah. Josh, thank you for having me here. Appreciate you having us here. You hit it right on the head. Solid state battery that QuantumScape is the technology leader in is a no compromise battery. By that I mean you can get range, you can get power, which means you can charge very fast. You can have reliability in the battery that you can cycle as many times as you want, and safety and cost all at the same time. Today, lithium-ion batteries dominate the marketplace. Most of the lithium-ion batteries come from China. China dominates that marketplace. Naturally, the lithium-ion batteries have limitations on how good they can be. Either you can get range in some cases, or sometimes you can get fast charging. You can't get both at the same time. And they have safety issues. What QuantumScape is demonstrating is that we can get all of them in the next generation of true solid-state batteries. And the enabling technology for this is a ceramic separator. The ceramic separator that keeps the anode and the cathode in a battery apart is unique to us. This ceramic separator, how we manufacture, is what we announced this week. The Cobra process improves the productivity of the heat treatment step in a ceramic by 25 times. You don't get to see that often in any technology, that one day you announce something that gets better by 25 times. That's the big breakthrough that allows our partners to now scale this technology to be in high volume manufacturing, that they can then put it in the EVs and other mobility opportunities.
Just even to compare and contrast, I'm just curious, if you had the typical battery pack in an EV, typical, Siva, that would give me a range of what versus what your technology could give me?
Yeah, as much as I would love to give that to you, Josh, you have to think about it in a comparative sense. Typically, a 100 kilowatt hour battery that you see in a high-end car gives you about, give or take, 350 miles. We measure that in a metric called energy density. A typical energy density that you see in a lithium-ion battery is of the order of 600 watt-hours per liter. Our first announced product has 844 watt-hours per liter, meaning more than a third better in our very first generation. That same battery is also very good with temperature. You can operate at very low temperature, very high temperature, and when you press the gas, the range doesn't drop dramatically. We are actually very good with respect to power. And you can charge it under 10 minutes or so. This is the kind of no compromise that the solid-state battery offers.
So the technology sounds impressive, Siva. Bottom line, in terms of timeline, when is it commercially viable?
So last year, in order to accelerate this timeline so that we can be in batteries as fast as we can, we developed a business model that is technology licensing based as opposed to us ramping it ourselves. For example, the Volkswagen Group became a major partner, signing a licensing agreement going towards manufacturing up to 500,000 cars per year or so in their own factories. We are working very, very closely with them in industrializing this. This Cobra announcement that we made yesterday is what makes that possible. And so when you talk about where, which car, at what time, etc., I better leave that to our licensing partner to give it to you than for us to say it. All I can say is our customers are working very, very closely with us to get it into high volume production as quickly as possible.
Siva, great to have you on the show today. Thanks so much for your time.
I appreciate it, Josh. Thanks for having me here.
Let's check in on stocks. We're just moments from the closing bell here. The S&P 500 right near that all-time high. I'm looking at 6143, right there, knocking on the door. The Dow, by the way, tacking on about 430 points. Nasdaq up about 1%. Stay tuned for Market Domination Overtime.